On the morning of January 28, 2026, a commodity trader in Singapore opened his screen and saw something that violated 40 years of market experience. Silver, two prices, same metal, same day, same planet. Shanghai showed $87 per ounce. New York showed $73. He stared at the numbers for 3 minutes straight, waiting for one of them to correct. Neither moved. The gap held. $14 separated what should have been the same price in two different cities. This wasn't supposed to happen anymore. In 1985, price gaps like this existed because information traveled slowly. A trader in Tokyo might not know what London paid until the next morning. Phones were expensive. Data was delayed. Geography mattered. But in 2026, information moves at the speed of light. Fiber optic cables cross oceans. Algorithms execute trades in microseconds. When gold is cheaper in London than New York by even 50 cents, computers buy London, sell New York, and pocket the difference before a human can blink. They call it arbitrage. It's supposed to make prices match everywhere, instantly. Except, it stopped working. The Shanghai price stayed at $87 while New York stayed at $73, and nobody could close the gap. Not the algorithms, not the banks, not the traders who'd built entire careers on making these differences disappear. Something fundamental had broken. Let's understand what this actually means. When someone talks about the price of silver, they're usually referring to the COMEX price in New York. That's the number financial news channels display. That's what mining companies use to forecast revenue. That's what determines whether silver ETFs go up or down in your portfolio. COMEX is the reference point, the benchmark, the official number. But here's the problem. COMEX doesn't trade physical silver anymore. Not really. It trades contracts, promises, paper claims on silver that mostly never gets delivered. Traders buy and sell these contracts back and forth, and at the end of each day, only about 2% actually request the physical metal. The rest just settle in cash and move on. Shanghai is different. In Shanghai, buyers don't want promises. They want metal, actual bars, delivered to vaults. They pay $87 because that's what it costs to walk away with silver you can hold. So now a business owner faces a question. Which price is real? The 73 number that shows up on financial websites, or the 87 number that people actually pay when they want the product? Here's where it gets serious. Imagine you run a solar panel factory. You need silver for production. You check the price, $73 on COMEX. You budget accordingly. You plan your costs. You set your prices to customers. Then you call your supplier to actually buy the silver. They quote you 87. You say, but the screen shows 73. They say, the screen shows futures contracts. I'm selling you metal. Metal costs 87s. Do you want it or not? You need it. Your production line stops without it. So you pay 87, 19% more than the official price said you should pay. Your entire cost structure just broke. This is happening right now to manufacturers across Asia, Europe, and North America. The price they see isn't the price they pay. The benchmark doesn't match reality, and it's not getting better. It's getting worse. On January 15th, the gap was $8. By January 22nd, it was $11. By January 28th, it hit $14. Every day, the distance between paper and physical grows wider. Traditional market theory says this can't last. Traders should buy cheap COMEX contracts, demand delivery, ship the metal to Shanghai, sell at $87, and pocket the $14 difference. Do this enough times, and the prices converge. Except they can't. The metal isn't available for delivery. China has locked down exports. COMEX vaults are running low, and the few traders who try to take physical delivery face margin increases, rule changes, and delays that make the arbitrage impossible. So the gap persists, week after week, and every business making decisions based on the $73 COMEX price is operating with corrupted data. They're building budgets on fiction, planning strategies on numbers that don't represent what anything actually costs, making capital allocation decisions using a benchmark that stopped functioning as a price discovery tool. The question isn't whether this matters. The question is, what happens when the reference price for a critical industrial metal becomes a managed illusion? And who decides what's real when the official number stops being true? 3 days before the price gap exploded to $14, something unusual happened in the offices of America's largest commodity dealers. Not unusual because it was loud, unusual because it was quiet. On January 19, 2026, J.P. Morgan's commodities desk sent an internal memo to clients trading silver futures. The message was brief, technical, bureaucratic. It said margin requirements for silver contracts would increase from $8,800 to $14,500 per contract, effective immediately. 48 hours later, Goldman Sachs issued an identical notice. Different letterhead, same message, margins up 65%. Within the week, Morgan Stanley followed, then Citigroup, then HSBC. 5 of the world's largest banks, all raising the cost to trade silver futures, all within 72 hours of each other. all using nearly identical percentage increases. If you've never traded futures, here's what a margin increase actually does. Imagine you control $100,000 worth of silver contracts, but you only put up $8,800 of your own money. The exchange loans you the rest through leverage. That's how futures work. Small money controls big positions. Now the bank says, your $8,800 isn't enough anymore. Post $14,500, or we close your position. You have two choices. Send an additional $5,700 immediately, or they liquidate your contracts and you're out of the trade. Most traders don't have extra capital sitting around. They're already leveraged across multiple positions. So when margin requirements jump 65% with zero warning, they don't add money, they sell. And when thousands of traders sell at once, prices collapse. Here's what makes January 2026 different from every other margin increase in modern history. Exchanges raise margins during volatility. When markets go wild, when prices swing violently, when risk spikes, that's when they ask for more collateral. It makes sense. Protect the system during chaos. But silver volatility in mid-January 2026 was falling, not rising. The numbers don't lie. CME data showed silver volatility at 18% on January 15th. The two-year average was 22%. The market was calmer than normal, not more dangerous than normal, yet margins went up anyway, not during a crisis, before one. On January 22nd, the impact became visible. COMEX silver open interest dropped by 12,000 contracts in a single trading session. That's 60 million ounces of paper silver, erased from the system in one day. The selling pressure drove prices down 6%. In New York, COMEX silver fell to $71. In Shanghai, physical silver rose to $85. The gap widened from $11 to $14 in 48 hours. Now here's the question every serious analyst started asking. Why would banks simultaneously suppress their own market? The answer sits in a document most people never read. The Bank for International Settlements Quarterly Derivatives Report. Page 47 of the Q4 2025 edition shows U.S. commercial banks holding $89 billion in precious metals derivatives. Not physical metal, not mining stocks. Derivatives, bets on price direction, contracts that pay out or blow up depending on where silver closes each month. Most of those positions are short, meaning the banks profit when silver goes down and lose catastrophically when it goes up. At $73 per ounce, those positions are manageable. At $85 per ounce, margin calls start triggering across derivative books that dwarf the capital buffers banks hold against commodities. At $95 per ounce, the math stops working entirely. So the institutional priority shifted, not from managing risk to taking risk, from price discovery to position defense. The margin increases weren't designed to protect the market from traders. They were designed to protect banks from the market, and it worked. Leveraged speculators got flushed out. Paper silver positions liquidated, COMEX prices dropped. The short position survived another month. But here's what didn't change: physical demand. While paper prices fell in New York, buyers in Shanghai kept paying higher premiums. Manufacturers kept needing metal. Industrial users kept placing orders. The real economy kept consuming silver faster than mines could produce it. The institutional response revealed something critical. When the reference price for a commodity becomes a tool for managing institutional exposure rather than discovering market value, every participant using that price is making decisions based on someone else's risk management needs, not supply, not demand, not fundamentals, not just the derivative books of 5 banks trying to survive their own bets. And the gap kept growing. While analysts debated futures contracts and margin calls in New York, a jeweler in Dubai's Gold Souk district faced a simpler problem. He couldn't buy silver. Not at any price he'd ever seen before. His supplier, a man he'd worked with for 17 years, called him on January 23rd with an update that made no sense. 1,000 ounce bars are $120 per ounce. Minimum order 10 bars. Delivery in 8 weeks. The jeweler laughed. He thought it was a negotiating tactic. The screen shows $73. You want me to pay $127? His supplier didn't laugh back. The screen shows paper. I'm selling metal. Metal is $127, and I can't get it for 8 weeks. If you want it, wire the deposit today. If not, I have 12 other buyers waiting. The call ended. The jeweler checked 3 more suppliers. Same story. Different numbers, same pattern. Premiums between $48 and $54 over COMEX. Delivery time stretched from 72 hours to 2 months. Something had broken in the physical supply chain, and the break didn't show up on any financial screen. Let's follow the metal itself. Silver comes out of the ground in roughly 830 million ounces per year. Mines in Mexico, Peru, China, Australia. They dig, process, and ship concentrate to refineries. But ore isn't investable. You can't make a coin from mining concentrate. You can't manufacture a solar panel from unrefined material. The metal has to be purified to 9Hi99 fineness, cast into standard bars, stamped with refinery marks, certified for delivery. Only about 450 million ounces reach this refined bar form annually. And here's the critical detail most analysis misses. 68% of global silver refining capacity sits in China, not mining, refining. The final step that turns raw material into usable product. On January 8, 2026, China's Ministry of Commerce issued Export License Requirement 2026-003. Buried in subsection 4.7, a single sentence changed everything. Refined silver products exceeding 0.95 purity require individual export authorization. Processing time 45-90 days. Translation: China didn't stop producing silver. They stopped letting it leave the country, or more precisely, they made it so bureaucratically difficult that shipments slowed to a trickle. Within 2 weeks, the impact rippled across Asia. Singapore bullion dealers, who normally stocked 500,000 ounces, reported inventory down to 50,000 ounces. One dealer told clients bluntly, "We're rationing. 2 bars per customer maximum, no exceptions." In London, the Bullion Market Association reported something that hadn't happened since 2008. Allocated silver withdrawals exceeded deposits by 18 million ounces in 6 weeks. Allocated means specific bars, serial numbers, sitting in vaults with your name on them. When allocated inventory starts disappearing, it means people aren't trading. They're taking possession and leaving the system entirely. But the most revealing data came from a source nobody was watching. India's Ministry of Commerce publishes monthly import statistics. Page 127 of the December 2025 report showed silver imports up 340% year over year. 340%. Not from jewelry demand, not from industrial growth, from government purchases building strategic reserves. India wasn't alone. South Korea quietly doubled its sovereign silver holdings in Q4 2025. Thailand's central bank bought 4 million ounces through undisclosed intermediaries. Saudi Arabia's public investment fund allocated $400 million to physical precious metals. Specifics classified. Governments were buying, but not through transparent markets. These purchases never touched COMEX, never showed up in ETF flows, never appeared in retail investment data. They went straight from refineries to sovereign vaults, bypassing every traditional price discovery mechanism. Now add industrial demand. Solar panel manufacturers consumed 156 million ounces in 2025, up 23% from the previous year. Every panel needs silver paste for conductivity. No substitute exists at commercial scale. Electric vehicles need 25 to 50 grams per vehicle. At 14 million EVs produced in 2025, that's another 18 to 35 million ounces consumed permanently. 5G infrastructure build-out added 42 million ounces. Medical devices, electronics, water purification, antimicrobial applications, another 200 million ounces. None of this silver gets recycled quickly. It's embedded in products with 10 to 25-year lifespans. So here's the math that creates the crisis. Annual demand from industrial plus investment, 1.1 billion ounces. Annual production reaching refined form, 830 million ounces. Deficit, 270 million ounces per year. COMEX registered inventory available for delivery, 41 million ounces. At the current deficit rate, COMEX holds exactly 15 days worth of global shortage, 15 days. And while that inventory drains, while China restricts exports, while governments stockpile, while manufacturers compete for supply, the COMEX price shows $73, as if nothing has changed, as if supply still meets demand, as if the metal still exists. A manufacturing executive in Stuttgart faced a decision that wouldn't wait. His company produces high-efficiency solar inverters. Each unit requires 240 grams of silver. Annual production, 85,000 units. That's roughly 650,000 ounces of silver per year, every year, non-negotiable. His procurement team presented him with 2 options. Option 1, lock in a 3-year supply contract at $89 per ounce with guaranteed delivery. Total commitment, $173 million. Price fixed, supply secured. Option 2, continue spot purchasing at COMEX-linked pricing, currently showing $73 plus normal premiums of $3, total $76. Save $13 per ounce, keep flexibility. The spreadsheet said, Option 2, save $8.5 million annually, maintain cash flow, standard business practice. But the spreadsheet didn't account for what happens when the metal stops arriving. His suppliers in Switzerland were already quoting 12-week delays. His plant in Mexico couldn't source local inventory at any premium. His logistics team reported 3 failed delivery attempts in January alone. Contracts signed, deposits paid, metal never shipped. He chose option 1, locked in 3 years at $89. accepted the $13 premium over COMEX because production lines that sit idle cost more than expensive silver. This is the decision framework business leaders now face across every industry that touches physical commodities. Not which price is better, but which price is real. And real doesn't mean lower. Real means the price at which supply actually moves. Let's break down the 3 scenarios that determine what happens next. Scenario 1, convergence probability, 35%. In this outcome, COMEX prices eventually rise to meet Shanghai. The gap closes through traditional arbitrage as export restrictions ease or new refining capacity comes online. Prices stabilize in the $82 to $80 range within 6 months. Who wins? Anyone holding physical metal bought below $80. Manufacturers who locked long-term contracts. Mining companies with unhedged production. Who loses? Paper silver holders who sold during margin call liquidations. Banks holding short derivatives positions. Anyone who waited for cheaper prices that never came. Scenario 2, permanent fracture, probability 45%. The 2-tier pricing structure becomes permanent. COMEX remains a financial instrument for speculation, disconnected from physical settlement. Shanghai, Dubai, and Singapore established their own pricing mechanisms based on actual metal delivery. This already happened in palladium markets in 2021. Paper prices diverged from physical by 30% and never reconnected. Traders learned to ignore the futures screen and negotiate directly with refineries. Who wins? Anyone with access to physical supply chains, companies with direct refinery relationships, nations with domestic refining capacity. Who loses? ETF investors holding paper claims, pension funds allocated to commodity futures. Anyone assuming financial instruments still represent underlying assets. Scenario 3, disorderly reset probability, 20%. A major contract holder demands delivery that COMEX cannot satisfy. The exchange either forces cash settlement at discounted rates or retroactively changes contract specifications. Legal challenges follow. Confidence in commodity futures collapses. This is the low probability, high impact event. Unlikely, but not impossible. The math is simple. 180 million ounces of open interest chasing 41 million ounces of registered inventory. If even 25% demand delivery simultaneously, the system breaks. Who wins? No one initially. Market chaos benefits only those positioned in physical metal outside the exchange system. Who loses? Everyone holding leveraged positions. Brokers, exchanges, institutional credibility. So what does a rational business leader do with this analysis? First, separate paper exposure from physical allocation. If you need silver for production, treat futures prices as irrelevant. Negotiate directly with refineries. Lock supply, not price speculation. If you're investing financially, understand that ETFs and futures now carry delivery risk that didn't exist 5 years ago. The share price might say $73, but liquidation might happen at $60 if the underlying metal doesn't exist. Second, recognize which price reflects equilibrium. COMEX trades 200 million ounces daily in paper volume, but only 800,000 ounces actually change hands physically. Shanghai trades 15 million ounces in paper volume, but 8 million ounces settle in physical delivery. The market that clears metal is showing you the real price. The market that clears contracts is showing you sentiment. Third, understand the systemic signal. When major commodity markets display persistent 2-tier pricing, when paper trades 19% below physical for weeks, when institutional banks coordinate margin increases during low volatility, this isn't just about silver. It's about what happens when financial instruments decouple from physical reality across all asset classes. The only reliable information left is the price someone pays to walk away with the actual product. Everything else has become risk management theater. And in that environment, the decision isn't complicated. You either own the thing itself, or you own a claim on something that might not be there when you need it. Choose accordingly.